Good morning, ladies and gentlemen. Welcome to the 6th FINEX conference. I believe it's the 6th, it said in the programme. I'd like to thank, first of all, Mike Armitage for dropping me into this role, as he ducked out about 3 weeks ago. But it's my pleasure to introduce you all to this event, and really, first of all, to thank the sponsors and to thank the organising committee. FINEX is a conference which has been going for many years now, and very successfully brings together the financial and the development and exploration communities from around the world. So it really is my pleasure to kick this off. What I thought as a little warmer to get you all into the mood, I've got a few slides. I'm just going to kind of introduce I hope I've got a few slides that'll introduce the theme of the flow of the event as we're going to see it. So my name's Phil Newell. I'm the Managing Director of Wardle Armstrong International, based down in Cornwall. And as you can see here, I'm just going to talk a little bit for about 8 or 9 minutes on trends in the mining industry. Some of this, of course, will come up during the next 2 days, probably in some more detail, but this is like a little sweetener. So the markets, what's affecting them? Well, broadly speaking, as we all know, supply and demand is the big ticket for all of us. And at the moment, you can argue all day about whether certain commodities are in deficit or in surplus. But of course, we're in a very interesting environment at the minute, and there are all sorts of things going on, as I like to say, left field, which are affecting what we all do. And without in no particular order, sanctions, the Trump factor, of course, has a link through to that. China, conflict around the world, trade wars, which we've all seen are kicking off at the minute, the whole electric vehicle story, I'll come back to that again shortly, renewable energy, how that's progressing, and the Brexit deal, which we're all, for the UK-based people here, right in the thick of it. The international situation, well, broadly speaking, sorry, I've got to stand in the middle, haven't I? I don't get videoed. There is a situation of optimism, I guess, with an infrastructure fuels metals boom, China continuing growth at 6% plus-ish, and fiscal expansion. However, on the other, yes, can I just tell everybody please to put their phones off? I forgot to announce that at the start. The pessimism side is exactly the reverse of what I've just said. So it's the Chinese economy. People worry that it's only 6%. Well, hang on, it's 6%. There's a lot of people live there. Just throw it out the window. Potential US trade war. Well, it's not potential anymore. I put these slides together about 4 weeks ago. So one could argue we're in the thick of that now. And then there's the left field factors. And also the mining industry itself is really struggling to recover from a pretty major downturn as the last 4 years. But it says their exploration was at its lowest in 2016. It's nice to see, and you'll see in another slide in a minute, that it has kicked up in 2017 a little bit. So exploration dominated still by the world's largest companies. And that's an important factor, which again, I'll briefly come back to in a minute. Recent metal price corrections. Again, we've all seen metal prices spike at back end of last year and the early part of this year. And if you look here, we've got zinc spot, tin, copper, and gold. I say these were recorded about a month ago. They're pretty much as they are, as you see on those boards. So some of these, have we passed the current peak? Are we on the way down slightly, or are things going to stabilize? One that stands out from the crowd, thermal coal. I guess if people had been asked to make a pick of 12, 18 months ago, what would be the best performing commodity out there, or one of the best, a lot of people would have struggled to pick thermal coal. And this is all being driven effectively by the fact that there is a lot of concern that to feed the EV story, the power demands that will require, the only way you can get to these targets quickly is to ramp up the thermal coal usage, because renewables just won't cut it at the minute. So that's a very interesting story. And also, of course, China is cracking down on its polluting industries. Moving on, I'm very mindful of the time here, so this is a quick flash through. So it is inevitable. We are moving towards the EV story. That is just going to happen, and renewable energy. And battery demand will increase. China's the fastest growing market. They're predicting, whether these figures are right or not, between 40 and 70 million units by 2025. Units, that's vehicles. I mean, that's just a staggering number. And therefore puts huge pressure on the electricity networks. And renewable energy is rising, but issues with intermittent output and storage. That storage one is a key factor. How do you store power from renewable energy sources, particularly if they're offshore, etc.? It is a problem at the moment. Demand surge. This is one that's probably going to be very appropriate to most of the people sitting in the audience here. You can see some of the key metals there. In terms of where we sit now, down in 2018, in terms of demand, it's pretty low, to where we may be in 2030. Some of the key ones there, which I'll flag up, are graphite, for instance. And again, for the geologists in here, most people who are familiar, a lot of graphite deposits around the world are fairly small. They are going to struggle to provide any kind of supply for that demand. Copper, as you can see, still retains a major part in the story, as does cobalt, and as we know, there are various problems with some of these commodities. Vanadium is another one which isn't on there, but vanadium hit a price peak last week. I'm not sure what it's done this week, but that's been creeping up over the last 18 months. One at the bottom here I threw in, anybody in the PGM markets, as we move towards electric vehicles, the need for platinum for catalysts in cars, of course, disappears. That could be an issue. So metal prices, EVs, this is one which I guess people in this market maybe don't want to tend to look at too closely because, as you can see, particularly lithium here, major spike at the beginning of the year, prices have come off. Cobalt, where's cobalt on here? Can't even see my, cobalt, this one, again, spike earlier in the year. These prices, most of these have actually come off even more since these graphs were put up. So there's many arguments about whether they are going to rise again. I think the majority of consensus is that they will. My own personal perspective on this, pretty happy about things like cobalt going to come back because it's just, there's, as you know, very few discrete supplies of cobalt. It tends to be a byproduct. Lithium's the one that worries me. Apologies to those people who are in the lithium space here. Potential risks. Okay, insufficient critical metals such as cobalt. I've covered that. Battery technology evolving, but might be different metals may become more important in the next year. Is there some boffin sitting in a little lab in China going to come up with the next new thing? And other known technologies, such as hydrogen fuel cells, people who read the news probably noticed that Germany started, they pushed out the first hydrogen fuel cell trains, I think a couple of weeks ago, to run on commuter lines which weren't electrified. Again, that's something that may take off globally. And the last one there, development of unknown. Well, there's always that, isn't there? There's the unknown. So who knows what might happen, but broadly speaking, we are pretty much entrenched in the EV cycle. So very quickly to finish off on the exploration budget side of things, this is a very important graph, and it should be a relief to all of us. That has now ticked up slightly in 2017, exploration spend globally. I won't go through the numbers there. This one is more worrying in that where is that exploration money being spent? As you can see, it's still increasing at mine site. It's increasing over late stage projects, but unfortunately, for grassroots project, the amount of exploration spend is still decreasing. That's building up for a storm, because as we all know, if you like, broadly, the days of the big deposits are pretty much gone. There'll be a few found, but effectively we are looking at smaller deposits, deeper, more refractory, harder to treat, harder to mine, and therefore, instead of this graph doing that, this one really has to be doing this, or else we will be in trouble in time. When that time is, I don't know. And that's just summarising what you see there. The battery metal issue, of course, will hopefully pull this one up a little in coming years. Okay, and where is it in terms of by commodity? Well, the EVs, the battery metals, are in this other, but of course gold and silver, still one of the major commodities, with base metals, if you like, second in line. Exploration summary. So we can see there that it is picked up after low points. Majors are desperately trying to replenish their resource bases. Hence, most of the exploration is being done by the majors and pretty much around their mine sites. That's where the common practice is. And finally, target developments, expansion of the underground operations. Again, that's something that we're all very familiar with as mines become more difficult. So building for a storm. Is this all going to, at some point, go bang? Financial capital raising increased slightly in 2017. IPOs have ticked up a little bit, but broadly speaking, things are still difficult. Good projects are getting financed. Average projects are struggling, as many of you in the audience will know. Copper's still attractive, but again, these things have got to be good to attract the financing. There's been a lot of interest, of course, in the battery metals, and most seminars, things you go to around the city, they're the ones that carry the numbers, the people, because people are interested in that, and there will be a huge market in there. Private equity firms are getting involved in this, but we're noticing that some of the PE firms are taking a different role in their projects. Instead of looking for distressed assets in production, they're taking a step back now and putting money into exploration, which is actually very encouraging for all of us to develop those projects through to production. So they're looking at a longer lead time. Long may that continue. That will do for that, and we're approaching the end, don't worry, whoever's watching the clock on this one. I think that's probably me. MA activity, as again you can see, this has ticked up a little bit in 2017, but nothing too substantial. China, of course, is the main beneficiary, as well as it's on both ends of the cycle there, on the M&A side. And coal and steel, still main drivers, and as they will be for many years to come. I think everybody sort of media very often writes off coal, but that's going to be around for a while. So, global outlook. Market's probably going to remain strong. This is just really my thoughts plus reading on various journals, etc. However, the oversupply and demand, need for battery metals, of course, will pull that through. Future supply, some metals, problematic, and at copper, zinc, cobalt. China likely, 6% growth will drive a lot of this. M&A activity likely to continue. IPOs on the rise, we hope. But that last number is one that we should all take on board through this two-day conference, is that by 2050, they think another 2.5 billion people will effectively be urbanized with their needs for fridges, cars, etc. I, as a mining geologist and a practitioner who've been involved in this industry for 35 years now, I do have concerns as to how we're going to cope with this, because for some of the reasons I gave you earlier on, and that'll do for me. Thank you very much.